Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, August 7th, 2013. In this video, we're going to do a quick overview of the world markets, some of the key global indices, starting with the U.S. and working our way out east. So let's take a look here at the S&P 500. We're starting out on a monthly chart. I'll try to look at the longer term time frames and work my way down to the daily. Um, okay, so what we're looking at is a multi-decade chart on the S&P 500, and we see prices pretty much making a triple top and actually just breaking out here recently, as we all know, to new all-time highs. And what this chart shows, as most of my charts do, I use different colors on trend lines to indicate the significance. On this one, I have this long-term primary uptrend line, which we kissed back at the ending of at the bottom of the bear market back in March 2009, before this new bull market began. And so we have several reactions going all the way back to 1974 here on that trend line. So that's something at some point in the future will probably be tested once again. And then if you look a little closer, let's zoom in. We have these blue, what I like to call sub or minor uptrend lines. And of course, these define, cyclical bull markets here. And we had this last one that broke back in 2000 that led to the bear market. I'm sorry, that followed that bull market. And as you can see here, so when those sub uptrend lines break, that's when you tend to, at least as defined by these blue lines, these are defining the last few cyclical bull markets. And this is the one that we're currently above now as we break out to new highs. So let's see where we go from there. And this would be a key uptrend line to keep an eye on. As noted down below, we have long-standing divergences. In the bullish case, we have broken out to new highs and taken out this trading range, or this triple top here, and that is the bullish case. And prices first and foremost. So as long as prices do remain above this horizontal line here, that is a bullish technical event. Of course, we did have negative divergence, long-standing divergences here. Again, we're looking at a monthly chart, multi-year, pretty much decade-long divergences on the RSI and the PPO, which could be a caution sign that maybe this breakout doesn't stick and continue on going forward. So let's move down to the weekly chart and take a look at what we see there. Here is our uptrend line, the white line off the bear market lows back in March 2009. So that's a line to watch. And I also have these yellow uptrend lines defining a sort of a contracting channel / rising wedge pattern. And as we note down below, divergences continue to build, and that's why I question these highs. Not only are these new highs not accompanied by above average volume, as you like to see on a breakout, but we have very low and diminishing volume on this breakout. So that is another cautious sign. This market just continues to grind higher regardless of a lot of divergences in place, not just on the oscillators shown below, but as I mentioned, volume. So something again to watch. But from a technical perspective, a pure price perspective, as I mentioned in the video I did last week on the S&P 500, this is bullish action. We had a breakout here of new highs, a back test of those previous highs back here in 2007, and that back test held and prices moved higher. So as long as we remain above this red line, that's bearish action. Now, being the fact that we already had one retest, to see prices come back here will really call those new highs into question. Yes, we can continue to retest. That is possible. But if you just take a quick visual here on these uptrend lines, these are key support lines. Here, the yellow uptrend line, which comes in right around that primary uptrend line, the white uptrend line. So if prices were to come back, let's just draw that real quick. If prices were to come back in, it would look something like this. We would be testing both the breakout to new highs as well as these key primary uptrend lines, and that would be a level to watch, and would quite likely a break below moving down here would quite likely call this current bull market the cyclical bull market that we've been in into question. And that would be a major technical breakdown. So we're not far off those levels, but until that happens, as I said, prices remain, in a solidly entrenched in an uptrend. Talk a lot about divergences, and for months now I've been mentioning those divergences, and they have played out. If you take a look here at the white uptrend line and the downtrend line here on the RSI, I haven't drawn it here, but we also had negative divergence in place. Had I put a line over here, let's do that real quickly. From here to here, we had negative divergence from this peak to this peak, which I had talked about, and that did lead to a correction. We had this correction down here. So these divergences, more often than not, do play out. And that divergence played out for a correction. It found support on this uptrend line. Given at the time, I thought we might come back up and go down and ultimately break below this trend line, but that didn't happen. We held support here, and prices pushed on to make a new high. However, in doing so, we continue to diverge. We just have different, longer standing divergence here, as marked by this yellow downtrend line on the PPO and the RSI down below, and prices continue to make this new high while diverging. So once again, I would expect in the near future, these divergences have now been put in place as of last week, and I would expect a move back down in the near future. And by near future, I mean the upcoming weeks and months here. Whether we make a marginal new high or not, I do expect to see these uptrend lines tested within the next couple months here. And let's take a quick look at the daily chart. And these are the divergences I talked about. So if we go all the way back down, to the daily chart, we have negative divergences as prices continue to make higher highs, with the most indicators and oscillators down below making lower highs, i.e. negative divergence. Okay, moving on now. This is the Toronto Stock Exchange. I'll move a lot quicker on these remaining indices so I can cover all of these and try to keep this video somewhat manageable here as far as time goes. The Toronto Stock Exchange, we're looking at starting at a monthly chart, very long-term uptrend line. A lot of touches, going all the way back to 1985 here on this chart. 1, 2, 3, 4, 5. So this is just a trend line to watch in the future, and trend lines tend to act like magnets. Prices will get away from those trend lines and at some point revert back to the mean and tag those trend lines, as you can see here in these corrections. So, whether the next touch is years away or months away, it's hard to really say looking at this chart. Let's take a look at the weekly. Okay, this gives us a little more insight. This orange uptrend line is off the early 2009 lows, and the TSX, this is a little bit more bearish looking. Something to note here that the of all the global indices I'm going to cover today, only the S&P and the Frankfurt Dax have made new all-time highs, and by very, very slight marginal amounts on both of those, especially the DAX. The FTSE's close, but not there yet. So that is something else that is of concern right now. Remember, the U.S. led the way in the money printing game. Now we have other, everyone else is coming in and following suit now. So we have a race to the bottom, they say in the currency wars, to see who can devalue faster. So not surprisingly that the U.S. has, led the way out of the gate here, as we got a big jump on our money printing process. So Toronto Stock Exchange, nice breakdown here of that long-term cyclical bull market uptrend line. We came back tested it, moved slightly above it, fell back down, and again we have just recently back tested and rolled off it. So from a technical perspective, price perspective, looking a little more bearish than bullish until this. I have a slightly upsloping resistance line here, and if that line is taken out and we move past these previous highs, that'll look a little bit more bullish. But until then, we have broken down. This is a key support level down here. Again, weekly chart on the Toronto Stock Exchange. On the last, I've been a couple weeks or a couple months actually since I've put up any charts on the TSX. But I had, I think at this time, this is the last time I covered it, we had these negative divergences in place on the highs, and we had a sharp correction. I had listed this support zone and this support zone, And as you can see, that most recent correction came down and kissed the bottom of that support zone, again, which I've had on this chart, I believe, for months now. Perfect kiss of that support zone, and we did have a reaction off there, but we've come back to back test this uptrend line. So again, right now, and at least until the Toronto Stock Exchange can get up and take out this, call it 12,900 level, we're not looking so hot there. And here's the London FTSE, and we're looking at a weekly chart. These were the previous highs back in 2007. Ignore these arrows. That was from some previous discussions on this chart here. We had, this was our bull market uptrend line back going into the 2007 highs. We broke that down, began a new cyclical bear market, and we've had these uptrend lines along the way. And breaks of those uptrend lines lead to significant corrections within this current bull market. So this is the uptrend line that I'm watching right now. We're quite a ways from it. In fact, we're at the upper end of this slightly contracting channel right here. And as I noted not so long ago, we did have a breakout, a failed breakout. Prices pierced intra-week, made some new highs, but that breakout failed, and there was a violent reaction off there. And we often see that in trading, whether it's a bearish breakdown or a bullish breakout to the upside in a stock or a security or an index. If those breakouts don't hold, there's usually a quick reaction because you have traders repositioning. Bulls chase the upside breakouts, shorts tend to cover, and then if that breakout doesn't hold, you have to have those bulls immediately turn around and sell once they realize they were wrong. The shorts pile back in, and that tends to happen here. So that is what happened in the case of the FTSE. Now we've powered back up and are getting close to breaking out to new highs again. We have long-standing divergences. They're not completely drawn here, but if I were to add a line, going back all the way to 2010, prices keep moving higher here, while down below we're failing to make higher highs. There's a slightly higher high, I think, on the RSI, but it's virtually flat. The MACD and the PPO are making lower highs, so that's the FTSE. Take a quick look at the daily chart and see what we see here. Again, these negative divergences marked all along the way. Typically, we have these wedge-type patterns or channels, or at least, the very least, just pay attention to the downtrend lines. And when we have these divergences, as I talk about more often than not, they play out for these corrections. As you can see here, nice correction, nice correction. In this case, we had a breakdown and a very high-level retest or backtest of the uptrend line. Or wedge pattern, and that squeezed a lot of shorts out, convinced a lot of wrongs that breakout wasn't going to stick, and then boom, very sharp correction. Now this trading, if you look at this chart, this is just typical of the last few months, and this is why, in my opinion, and one of the reasons why volumes are pathetically low in most of the markets right now. The retail trader's out of this market with all this currency manipulation and market manipulation by the central banks. This market is dominated by the computers, the high frequency trading machines. The retail trader, it's just impossible really to get in on these uptrends. They don't let you in, and on the the reversals, they're quick and fast. So if you're not positioned ahead of time on either of these, very, very hard to trade this market. And this is just typical of what we've seen in a lot of these international markets lately. But regardless, overall, until the FTSE makes it and sustains a breakout to new highs, I don't have a strong opinion on this index. I'll just tell you that now. But again, going back to the weekly chart, this is all important. Until we make a solid and sustained breakout, maybe we do need to consolidate here more before that happens. But it would be nice to see a breakout on above average volume, and as well as seeing a lot of the other international indices breaking out as well to new highs and holding those highs, particularly the U.S. Okay, this is the Paris CAC 40, and this was a key downtrend line. The CAC is well off its 2007 highs, well below. here is a key resistance level. I've been pointing this one out for a while. Prices have come up and been rejected so far off that resistance level on that last attempt, and we're back up there now. So at least we're looking to on the CAC to make some multi-year highs. It'll be quite a while before we ever see new all-time highs. But from the bullish perspective, here's what we've seen. This is a downtrend line that defined the bear market, and we did have a breakout back here in 2012. Prices have moved up. Now they are wedging higher. It's not drawn here, but the PPO, the MACD is pretty much flat, as is the RSI, while prices move up within this wedge pattern defined by these two trend lines here. And we have that resistance to contend with. I had pointed out this support level, and we had those divergences in place last time we hit those highs, and we had a very sharp correction and found support right on that support line, pretty well defined support level. And so now we're sort of boxed in between those two levels. So where we go from there will be important. Do we break out? And if so, do we have a sustained breakout to new highs? That would be very bullish. There's really no price action until you go back to 2008 here. So it's clear skies if the CAC can get above this level and make a sustained breakout. If not, that is resistance until proven otherwise, and these are the downside support levels or targets. And real quickly, looking at the daily chart on the CAC, in the last update, I believe I would have pointed out this bearish rising wedge pattern. We had divergences here at this point at these highs. We did have a correction, but as I had this support line, this is a very well-defined support line. If you look back, follow to the left here, quite a few tags from below and underneath. So prices found support not only once shortly after the breakdown. That was a bit of a bear trap because we did break this uptrend line. However, found that support on that level, which I believe I had pointed out at the time. Prices bounced sharply back within the wedge all the way up to make a slight overshoot at the top of the wedge, but the divergences persisted, and boom, we had a very sharp correction, once again back down to that support level. So I'm still focusing on this wedge pattern here. It's been sliced through a few times here at the end, but we have enough tags on this yellow uptrend line to give it some validation still, and prices are now backtesting and challenging that trend line while also challenging these previous highs. So pretty key make it or break it level for the CAC. It needs to power up and put this level in the rearview mirror. That would be bullish, a move over these highs. And if not, we're more than likely going to come back down and revisit at least this support level, maybe some of these longer term uptrend lines as well. The Frankfurt Dax, here's the German market, a weekly chart. And, as I mentioned, this is the one of the few international indices that have made recent highs. In fact, it looks a lot like the U.S. markets when you take a look at the chart. So recently broken out to new highs. It failed when it made a back test, or I should say, came back under those highs. But we have this pretty well-defined uptrend line here, the white uptrend line, and that is a level to watch. Now, prices do. My concern here, if I had to put some money on the DAX, whether the next 10% is up or down, I would say it's going to be to the downside. We do have a little room to work our way up within this wedge, but not a whole lot of room. So my expectation, because of these sharp divergences in place, if you look down here, prices are diverging as we make this new high. Even if we make another thrust higher, I think that would probably be the last thrust up, and I think ultimately prices will come back down and break not only below this wedge pattern here, but fall back below the breakout to recent highs. And this is a key support shelf here. And if that level were to go, we have this yellow downtrend line to contend with. This really capped the moves all the way back to 2007. So here's a downtrend line which we can extend out a little bit. Quite a few reactions off that line. So this would be a downside target range of the horizontal support to this downtrend line if this wedge were to break within the next few weeks to months here. Okay, let's quickly look at a daily chart here on the DAX. All these patterns were covered in the past. We have these sub-uptrend line, minor uptrend lines. But this is the uptrend line that I'm really keeping an eye on. This again would be that the uptrend line or that wedge pattern just shown on the weekly chart. So this is a level to watch. If we can power up and make a new high, take out these highs and put that level in the rearview mirror, bullish. Until then, if prices turn back down, or even if we do make that marginal new high, let's draw this out here because this one does warrant taking a look at. Let's just say that we make a slightly higher high here on prices. What that's going to do is put some pretty strong divergences in place, assuming it's a marginal new high and we don't just rocket up to that 9,500 level. But even if we were to make a marginal new high, we would have pretty solid negative divergences in place here on the daily MACD, and that would, in my opinion, give us a very strong chance that those highs, that this trend line would break, that prices would come back down from there and ultimately break below this trend line. So, near term, you don't have any sell signals yet, but if we were to push up, make a slightly newer high and see some the shorter term charts start to roll over, it might be a good place to put a short on for those of you that like to trade the international markets. Okay, moving on. This is Australia. Here's the Sydney market. We're looking at a monthly chart going all the way back to 1985. Key, uptrend line here to keep an eye on. We're quite a way, comfortably above that trend line now. So let's zoom down to a weekly chart, and this is the trend line I'm focusing on at this point. We have the move off the 2009 lows. We had a slight pierce, but we have quite a few tags here. So this is an uptrend line to watch. Now, most importantly is the where we're at today. The Australian markets lagged quite a bit. Let's see. This is what I want to highlight here and take a look at this histogram. As you can see from the volume at price histogram, in the last decade or so, most of the trading has occurred below this resistance zone, these two horizontal lines. You can see these histogram bars. So we had just a relatively brief breakout back in 2007 when we hit the new highs and then fell back below. So since that point in time, we had some reactions back here, some reactions here, come back to back test that level, back test, testing it again from below. So we're knocking at this level now. I would think this is a very bullish breakout if the Sydney Exchange can make a sustained breakout of this level. We've had enough consolidation here, so I don't see any negative divergences. So this one longer term, this is looking like a better market in my opinion than the U.S. and some of the other markets that I just covered. So from a weekly perspective, and we did take out this downtrend line back in 2012. We had a breakout and back test. So, all in all, not a bad looking chart, but we do need to clear this key resistance level. And just zooming quickly to the daily chart, we did have on the last highs in on the Sydney Exchange. Remember that also was at weekly resistance. You don't see it here on a daily chart, but we had strong negative divergences in place, and as I mentioned, these more often than not play out. Oops, sorry about that. Okay, so negative divergences. We had a very sharp correction, and prices have moved back up since. We no longer have divergences in place. So again, not a bad-looking market. This would probably be your next support level here on a pullback, somewhere around that 4,900 level. But again, what you want to see here is a move over, a sustained breakout above this, we'll call it 5250-ish level, 5,300 if you want to be safe. Okay, I'll move a little quicker through these. This is India, the Bombay Stock Exchange. Here's another one. Trading a little bit below its highs. So we have these previous highs back here in 07, 2010, and until and unless the Bombay Exchange breaks out of there, that is a key resistance level. Daily chart, you can see we came up. We have this double top high so far, failed breakout here of these levels, and it's sort of building that double top base. This is a key support zone. So right now prices are in no man's land, in my opinion. If you were trading this index where you'd want to buy down here. If you get down towards the support zone with a stop not far below, and maybe try to ride it back up to the top, or you can wait for a long side breakout here of this resistance level. And one thing to note, of course, at that recent second high there, that attempt at the other high, we did have negative divergences in place, and that would have told you at that point, even if we were to have made a marginal new high, that wouldn't be, at least in my opinion, a breakout that you wanted to chase, because these divergences warned that that breakout probably wouldn't last, nor did it. We had a very sharp reaction off there, and again, that was foreshadowed by these negative divergences. Okay, enough of the glass half empty stuff. This is a little more, actually, some of my favorite global markets right now are the Asian markets, really ex-Japan. I'm not a big fan of Japan. One thing to keep in mind is I'm doing this video, the market's about to open. I started this video in pre-market today on Wednesday. This charting program I'm using does not update a lot of these international markets. We were down quite a bit overnight, so the charts that you're looking at really reflect the close through Tuesday. Now today's Wednesday, the close through Monday. Or I should say, they don't reflect Tuesday's overnight trading in the markets. Then maybe that's a little more clear. So a weekly chart on the SSEC, Shanghai Composite Exchange. We had this bear market downtrend line, the red downtrend line that defined the bear market all the way since the highs back in 2007. We had this breakout and successful backtest. So far successful. We came to backtest that line and have moved up. We have this very solid support shelf here below. All the trading activity on the histogram has occurred up in here in the last few years. So of all the indices, we could drift a little lower, test again, maybe make another tag of the support level. But the SSEC looks like one of the more bullish markets out there right now, in my opinion. Probably one closer to a bottom than a top, like a lot of the others that I covered. This is the daily chart. I haven't covered this in a while, but most of these annotations and trend lines were on the last one. We've had a lot of, it looks like a busy chart, a lot of stair-stepping down with these uptrend lines. We'd break an uptrend line, that would be bullish, we'd move up. A new uptrend line would begin, we'd break it down. So we've stair-stepped lower. And the last update I did on the SSEC, I pointed out this bullish falling wedge, but I also mentioned that we didn't have divergences in place. So we did get a breakout of that wedge, but being the fact that we didn't have positive divergences in place, it didn't go very far, came and hit this resistance line and had a very, very sharp sell-off. So again, this is reflective of the tough trading. But once again, I was skeptical of that any breakout sticking without the positive divergences in place, like I prefer to see on a daily chart before putting on a long swing trade. So at this point, we came back down. I had this downtrend line back at the time that I was mentioning we did have positive divergence on, and that led to that very strong rally back there. And I had since extended that downtrend line. If you look, we did a perfect kiss of that downtrend line, a perfect back test before prices found support. So again, one of the better looking indices. Hard to really give you an objective entry here because I don't see a lot of support below. Probably could draw a trend line here. Again, you can't trade this market directly. You'd have to use one of the proxies, ETFs like the FXI or those, but they don't track the Shanghai Composite directly. So I'll try to give you some proxies for those in the next few weeks here, few days. Here's the Hang Seng. No surprise, more bullish on this one than bearish, just like China. Obviously closely related index. And we have this downtrend line that defined the bear market off the 2007 highs. We had a breakout here, bullish breakout. Prices came, made a back test, and have moved up pretty sharply off that back test. So all in all, we have this, if you will, defined by these two lines, this trend line here and this uptrend line here, which I'll zoom out on in a minute. Sort of a symmetrical triangle pattern and a breakout and back test. So from a technical perspective, that looks more bullish than bearish to me. And this is a long term. I started out a minute ago. We were just looking at the weekly chart. This is a monthly chart. So here's our long term uptrend line going back from 1987. something to watch. Now, obviously, prices are well above that. We have this shorter term uptrend line, which helped define that symmetrical triangle that I was just talking about on the weekly chart, and the downtrend line. So prices remain above two support levels, this downtrend line and this one here. So all in all, one of the better looking global indices right now, in my opinion. And then the daily chart. You want to use the monthly and weekly charts to kind of give you an overview, a longer term outlook. But you use the daily charts for timing. And this is the Hang Seng. We've had these trend lines, uptrend line breaks. You had this downtrend channel, breakout bullish, sharp downtrend. We had a breakout. And currently, what I'm focused on is this rising wedge pattern, which prices have gapped below. So looking to enter that, I don't know. I'd have to check. Remember, this is not updated through last night's close, but to go long anywhere around this support line, maybe a little bit below there, that would be an objective long entry. We are looking at a pending MACD cross, and as I said, I'm leaning towards a correction. Some of the bigger markets, including the U.S., so I wouldn't be looking to jump in right now. But again, these are I do favor these the Chinese and the Hong Kong markets better than the most of the U.S. and European markets right now. And to wrap this up, here's the Japanese market, the Nikkei Tokyo Nikkei Index. Yeah, this is a monthly chart going all the way back into the mid 90s, and this is a downtrend line. This has been in a major secular bear market for decades now. They were decades ahead of us with this whole deflation mess, which I believe will be tangled in for years to come. But this is the monthly chart on the Nikkei, and prices remain, as long as they remain below this downtrend line, which is also resistance. They powered up very sharply with the Abenomics, their money printing that they're doing right now, and be hard to imagine that we just blast through this line, especially considering the scope of this move, and continue to run. So this is resistance until taken out. Weekly chart, this is a resistance zone. We had that sharp run up. We broke out of the symmetrical triangle. This is where they kicked in the BOJ money printing, massive money printing campaign. Overshot that resistance zone by a little bit, fell back sharply. This wasn't just a correction, that was a bear market. That correction there was over 20% in very short order, where we once again pushed to the top of this resistance zone. And I know last night, again, not reflected on this chart, we had a pretty sharp move down. So until this resistance zone is taken out, I view this chart as bearish. We've come up too much, too fast. Yes, we did have that correction, but it's still, in my opinion, a little too much, too fast. Maybe we consolidate and break out, but I'm not too interested in the Japanese stocks at this point. Okay, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed.